The Australian Taxation Office just sent a message to every crypto investor in this country, and it isn't subtle. New tax rules, tighter tracking, and a crackdown that could cost you tens of thousands of dollars if you're not prepared. But here's the thing. What's happening in Australia right now isn't just a local tax story. It's part of a global pattern, and the warning signs were there years ago. Norway learned this the hard way. Back in 2022, the Norwegian government projected a windfall of $146 million from its wealth tax. What they actually collected? A staggering loss of $594 million in tax revenue. Why? Because capital doesn't sit still. When you squeeze investors too hard, they leave. Their money goes with them. And the countries that welcome that capital, they boom. Ireland figured this out back in the 1980s. When they slashed corporate tax rates, something extraordinary happened. Intel moved in. Apple set up European headquarters. Google followed. The lesson isn't complicated. Capital goes where it's treated best. Always has, always will. And now Australia is testing that principle at the worst possible time for crypto investors. In May 2026, the Australian government announced 3 sweeping changes to capital gains taxation that sent shockwaves through the investment community. Let's break them down clearly, because every single one of them hits crypto holders directly. First, the 50% capital gains discount is gone. That discount, which allowed Australian investors to have their taxable capital gain on assets held longer than 12 months, is being replaced with inflation indexation. On paper, that sounds reasonable. In practice, for high-growth assets like Bitcoin and Ethereum, where gains aren't just beating inflation, they're multiplying it, this change dramatically increases the effective tax rate on long-term holders. Second, there's now a minimum 30% tax on all capital gains. Every disposal, every swap, every profit, no matter how complex your structure, 30% is the new floor. Third, negative gearing has been restricted to new builds only. While this targets property on the surface, it signals something broader. A government willing to use the tax system as a social engineering tool, and investors across every asset class are taking note. The stated aim of all 3 changes? Housing affordability. Make it harder to profit from assets, the theory goes, and people will stop competing with first home buyers. But here's where the evidence gets uncomfortable. New Zealand has no capital gains tax on investment property, and yet New Zealand consistently ranks as one of the worst housing markets for affordability in the entire OECD. Auckland has been one of the least affordable cities in the world for over a decade. If removing investment tax incentives automatically solved housing affordability, New Zealand would be the proof, but it isn't. Because housing affordability isn't a tax problem, it's a supply problem, it's a planning approval problem, it's a zoning problem, and no amount of CGT restructuring changes the fact that Australia simply hasn't built enough homes to meet population growth demand. So what does this mean for crypto investors? It means the policy pain is real, but the promised housing benefit is unlikely to materialize. Crypto holders are bearing a significant tax burden for a policy outcome that the evidence suggests won't be delivered. And the pain doesn't stop with the May 2026 rule changes. There's another critical date every Australian crypto investor needs to circle in red. July 1, 2027. That's the date everything splits. From that date forward, new cryptocurrency acquisitions will be taxed under the updated rules, including the minimum 30% rate and the loss of the 50% CGT discount. But assets acquired before July 1, 2027 under the old rules may retain access to the former CGT discount if they qualify. Why does this matter? Because of what's called the parcel problem. When you own Bitcoin or Ethereum or any cryptocurrency, you don't own one lump of it, you own individual parcels. Every time you bought, that was a new parcel. Parcel A might have been purchased in January 2023 for 18,000 AUD, Parcel B in March 2024 for 65,000 AUD, Parcel C in November 2024 for 95,000 AUD. Now, say you sell 1 Bitcoin in August 2027. The critical question the ATO will ask is, which parcel did you sell? The answer changes your tax outcome completely. If you can identify that you sold parcel A, the one bought in January 2023, it may qualify for the pre-July 2027 rules, meaning you might access the old 50% CGT discount. Sell parcel C, you're fully under the new regime. The difference in tax owed could be enormous, and the ATO will not do this calculation for you. The burden of proof sits entirely on the investor. But the parcel problem is just the beginning. There's a whole category of crypto events that investors habitually ignore until they're sitting across from an ATO auditor trying to explain 4 years of transaction history. Swaps. When you trade one cryptocurrency for another, say swapping Ethereum for Solana, that is a disposal. The ATO treats it as if you sold your Ethereum for Australian dollars at the market rate, then used those dollars to buy Solana. Every swap is a potential taxable event, every single one. Staking rewards. When you earn cryptocurrency through staking, you've received income. It's accessible the moment you receive it, valued in AUD at that point in time. Then, when you later sell those staking rewards, that disposal generates a second taxable event with its own cost basis calculation. Airdrops. If a project drops tokens into your wallet, the ATO may treat that as ordinary income at the time of receipt, not when you sell, when you receive them. Gas fees. Transaction fees paid in cryptocurrency may be deductible, but only if you're tracking them accurately in AUD at the time of each transaction. And wallet transfers. Moving crypto from one wallet you own to another you own isn't a taxable event, but it looks like one if you're not keeping records that prove both wallets belong to you. The complexity here isn't theoretical, it's the lived reality of thousands of Australian crypto investors who are right now sitting on years of tangled transaction history with no clean records and a July 2027 deadline bearing down on them. Here's something that surprises a lot of investors. The ATO already knows more than you think they do. Australian cryptocurrency exchanges are legally required to report user transaction data directly to the ATO. They know what you bought, they know what you sold, they know the dates and the values at the time of each transaction. What they can't see yet is everything happening in decentralized finance, hardware wallet activity, cross-chain swaps, staking on protocols that don't have an Australian regulatory footprint, DeFi yields, and liquidity pool positions. But here's the audit risk that sophisticated investors worry about. If the ATO can see your exchange transactions, the buys and sells, but your tax return shows a significantly lower gain than those transactions suggest, that discrepancy gets noticed. And when they come asking, the question is simple. Can you prove which parcel you sold? Can you reconcile every wallet? Can you explain the gap? If the answer is no, the ATO has the authority to make its own assessment, and their assessment is unlikely to favor the taxpayer. The government's stated intention behind these changes is redistributive, to shift capital from investment assets into housing supply. But the unintended consequences are already appearing. Australia's top marginal income tax rate sits at 47%. Add the new minimum 30% CGT rate to long-term asset gains, and the effective tax burden on successful investors is approaching levels that economists describe as confiscatory. That word matters because confiscatory tax rates don't just reduce investment returns, they eliminate the incentive to invest domestically at all. The response from Australia's startup and technology ecosystem has been swift and vocal. Founders from companies including Linktree have signed open letters to the federal government warning that these changes will accelerate capital flight and make Australia less competitive for high-growth venture investment. These aren't fringe voices. These are the founders of successful Australian companies, the exact entrepreneurs that economic policy is supposed to encourage. Canada saw this exact dynamic play out in 2024. The Canadian government proposed increasing its capital gains inclusion rate, a measure broadly similar to Australia's approach. The backlash from the business community was immediate and severe. By early 2025, the proposal was cancelled. So where does capital go when a country raises the cost of holding it? Superannuation, because the concessional tax rate of 15% inside super remains dramatically lower than the new CGT floor outside it. New builds, because negative gearing concessions are now concentrated there, creating a structural incentive toward that asset class. And offshore, because Singapore, Dubai, and New Zealand all offer capital gains regimes that are either non-existent or far more investor-friendly than Australia's new framework. What does all this mean for the Australian crypto investor watching this right now? First, get your records in order. Every transaction, every parcel, every staking reward, every swap, every AUD value at the time of each event. The July 2027 changeover date is not far away, and the difference between clean records and messy ones could be the difference between accessing the old CGT discount or being fully exposed to the new 30% minimum. Second, understand the parcel problem before you make any disposal decisions. The crypto you hold wasn't all acquired at the same time or under the same rules. Which parcel you sell and when matters enormously to your tax outcome. Third, consider how the new rules affect asset allocation. With superannuation's 15% tax rate looking increasingly attractive compared to the external CGT environment, the incentive to accelerate concessional contributions has rarely been stronger. Fourth, watch the policy closely. The Canadian experience in 2024 shows that capital gains hike proposals can be reversed when the economic backlash is significant enough. Australia's investment community is organized, vocal, and increasingly global in its outlook. The story isn't over. The ATO is hitting Australian crypto investors hard, that much is clear. But informed investors who understand the rules, understand the parcel system, understand the changeover date, and make decisions accordingly, they'll be the ones who navigate this shift with their wealth intact. The choice, as always, belongs to those who take the time to understand what's actually happening. And now, you do.